The broadcast is now starting. All attendees are in listen-only mode.
Hey everyone, this is Mitch Piper, National Membership Director here at ASTPS, and today we are going to be discussing statute of limitations with Roger Nemeth, who is the founder of Tax Help Software. And can everybody hear me all right? If you want to type in that chat box there, if you can hear us. Hear me? No, yes? Good, all right, cool. So before we get started, I'm just going to go over a couple of housekeeping announcements and just let you guys know about a couple upcoming ASTPS events that are going on. So actually the first thing is that this is actually going to be the largest webinar that we've ever done. We're going to have close to 1,000 practitioners on here. So it's one for the ASTPS history books, probably because Roger's just such a great guy that everybody just want to come hear him, I guess. I don't know. But so about the credit, if you guys want to get your 2 hours of credit, you have to be on here for 100 minutes and answer the 4 polling questions that are going to be, spaced out about every 15 minutes or so. And if you guys are listening by phone and you're not logged into the computer, then unfortunately I have no way to track your participation, so I'm not going to be able to give you credit. So make sure you're logged in on the computer if you want to get those continuing education hours. But you're definitely free to listen if you don't want the hours. Just want to make sure that you know that. We'll get the certificates out probably in the next 2 days, the day or maybe even tomorrow morning. We should have those out to you. They're going to be sent to whatever email you registered for the event on. And if you'd like to send in a question, we're going to do the questions at the end. There's a lot of material in this presentation to cover, so we're going to hold all those questions to the end. And if we have time, we're going to go through a couple. I'll read them off to Roger for you. And in that same panel, the panel to ask your questions is, if you look at the GoToWebinar chat panel, you'll see the question tab. You'll also see the handout tab. There's 3 handouts in there. There is one that's the slide. There's one that all of them are, Roger had sent me about 6 PDFs, and I combined 5 of them. So unfortunately, I think I put them in the wrong order. So you'll have to pay attention to what he's saying and then find the one he's specifically talking about. But you can download them there. Or if you see in the email that you clicked to register for this, they're in there as well. And let's see. I think that's it for the housekeeping. Just a couple of announcements for our upcoming events. We have our Buffalo Boot Camp. That's September 14th and 15th. There's about 10 spots left in that. That one's kind of unique. It's a smaller boot camp. There'll probably be less than 20 people in it, and it's right here in our office. We have the Las Vegas Super Conference coming up, and the room we have is about 50% full right now. We're working on finalizing the schedule. We should have all that to you guys hopefully next week. But the presenters we have lined up right now, as of right now, are L.G. Brooks, Robert McKenzie, Larry Lawler, Frank Augustino, Kevin Murphy, who just retired from being a special assistant U.S. attorney who represented the IRS in tax court and bankruptcy court. And we're going to have Darren Gillot back, who, for those of you guys who were at the spring conference, you'll know that he was an excellent presenter. He's very knowledgeable, and he was just a really good speaker as well. And he survived the grilling that everybody gave to him in that course, and he actually agreed to come back. So that'll be about 20 hours of continuing education for those of you guys who want to go to that. That's going to be October 5th, 6th, and 7th. We also have a boot camp going alongside that, which there's only about 12 spots left for that. That's also in Las Vegas, and you can stay for the 3rd day of the Super Conference. And let's see, I think finally there's just the last one of the year is going to be in Orange County, California. That's the boot camp. It's October 19th and 20th. So those are your opportunities if you want to come to a live boot camp this year. But that's all for me. Wait, what's this question? No. Okay. All right. Well, that's all for me. Roger, if you want to get started, let's get going.
All right. I've already done this presentation one time for the Florida Society of Enrolled Agents. It ran right at the 100 minutes. we were up against a hard deadline, so we kind of had to gloss over just the very end of the CSEDs, which seems to be the one that most people were interested in. So we've got the full 2 hours today. Just be advised, after an hour and 40 minutes, you can go ahead and log off. You'll get your credit. I gave you guys the PDF presentation. All the slides are in there. And there's also a cheat sheet, because whenever I do these classes, 3 weeks from now, you'll be sitting at your desk thinking, how do I calculate some of this stuff? And it's just a real basic cheat sheet to refresh your memory on the major topics that we're going to cover. So, all right, my name's Roger Namath. For those that don't know me, I'm an enrolled agent and also an NTPI fellow. I started managing tax franchises back in 2006. And I was working full-time as a law enforcement officer in Tallahassee, Florida, and got hurt real bad. And my wife said, time to go do something safe. So taxes appear to be safe. And hence, that's kind of where the detective came from, in Audit Detective, which I launched in 2010. Qualified as an NTPI fellow in 2015, worked as a programmer for the largest tax resolution company integrating the automated transcript system into the workflow program. And during that time, I assisted in the downloading and research of over 30 million transcripts. Back in 2010 was when I started to first research ACEDs, RCEDs, and CSEDs. I always thought CSEDs were the hardest one to calculate, but it turns out RCED is much more complicated than the CSED calculation. To date, our software has been used to download just under 1/5 of a billion transcripts. I don't get to see them, but what I do get to do is when our users call us with a question, especially on CSEDs, RCEDs, and ACEDs, that's how I keep my proficiency up, as I do the consulting to folks that call us with active cases. I can also see how the IRS treats those active cases as they're going on. So real quick presentation overview. This presentation will cover the IRS statute of limitations. The 3 statutes are assessment, ACED, refund, RCED, and collection, CSED. The IRC and IRM are severely conflicted and confusing. Also, certain events can extend the statutes. These events are referred to as tolling events and can complicate the statute calculations. The presentation will cover calculating statutes and contesting them with the IRS. The focus of this presentation is on the individual account, but some business rules will be covered as well. First time I've ever put a disclaimer in, but it was kind of important on this one, and I wanted to put it out there because it's not clear cut on some of these positions that the IRS takes and how they're defined. But there are conflicting statements between the IRM and revenue rulings and some unclear verbiage in the code as well. My advice is to always make a claim for refund or file a return before the due date or timely file date when possible. Please do not interpret this presentation or presented examples as an excuse to skirt the rules, as you may cost your client significant money. But thanks to Murphy's Law, I've personally observed on multiple occasions where a taxpayer comes in that gray area time frame between the due date and the extended due date from a look-back event. In those cases, if you choose to appeal a denial, this presentation will help with your position. Those are the clients that walk in to do their extension return and you realize that they left a lot of money on the table a few years back. And it's October 15th and the question becomes, is it worth trying to put a claim for refund in? Okay, handout overview. I did several IRS revenue rulings that have specific examples of RCED scenarios. IRS Chief Counsel opinion on RCED. An IRS Chief Counsel opinion on pending IA affecting CSED. If you don't look at any of the handouts, please try to look at the 2 Chief Counsel opinions. They show you how, I don't know what the best word to use is, but how the IRS is actually not following their own rules due to programming limitations. So I also did a summary of the PowerPoint and then the statute summary cheat sheet that Mitch described. That's a great little resource to keep on your desk. All right, layman's definition of statutes. The statutes are deadlines defined by law that affect the taxpayer's debits and credits on their IRS accounts, known as modules or periods. Just a little piece of trivia here. Most people don't really realize what a Social Security number really is. Technically, it's just your bank account number, your debit credit account with the Department of the Treasury. That, at the basic function, is why we have our Social Security numbers. So, what is statute of limitations per the statute? And I've already covered it. Anytime I give you the broad overview, I'm going to list the statute right after it. Here's the statute. I'm not going to read it to you per rote, but it is here. The way that I wrote this presentation, just so you know, is This presentation is made to where you can keep it the digital copy or print it out for those that still print things out. If you ever have an ACED, RCED, or CCED case, it's a great resource with all the sites for both the statutes, the IRC, the IRM, and some revenue rulings that you can use to argue your position. So keep it as a great resource. I'm not going to bore you with reading every single IRC and IRM code that we have, but I did list them for your reference. All right, substitute for returns, right? This is from the IRM, and the posting of the SFR does not set the ACED, RCED, or collection statute expiration date master file date, okay? This statement in the IRM leads to confusion about how an SFR affects the statutes. The SFR will be discussed in each assessment section. Can't tell you how many times, if I had a dollar for every time somebody told me that an SFR does not start the CCED, I would be a rich man. So I can tell you from personal experience and actually seeing it, CCEDs are based on assessments, not on the filing of the return. So the SFR is kind of irrelevant to affecting the CCED. And I know that based on experience of seeing at this point probably over 200 or 300 actual cases where it was an SFR only and the debt was dropped off. All right, the importance of the return file date. The ACED and RCED rely on when and if the original return file date is. The CCED relies on the assessment date, okay? And something as simple as when was the original return filed becomes very complicated. The only question in taxes that is more complicated than what is the original return file date is, are you married when you ask your tax client? That seems to be the most difficult question for taxes. This seems to be the second one for us tax pros to figure out. Okay. When is a return considered filed? In general, a document is filed on the date that it is received at the place designated for filing by the service. Okay. I didn't cover the IRM examples. I cover some specific ones later on, but I didn't dig into the exact examples here. But as simple as that statement seems, the return comes in, it's filed, that's the original return file date. Well, as we know, 80% of the IRS is easy and 20% is the exceptions. All right, so the easiest way to determine the return file date. On the account transcript, presence of a 150 tax return filed transaction, and then look at the return due date or return receive date, whichever is later, okay? And there's the example right there. Note, this also comes up quite a bit. The processing date is often confused with the filing date. The processing date has to do with the movement of money, such as the refund or applying payments to the Department of Treasury. Processing date is not the file date, okay? Just keep that in mind, okay? How to determine if an original was filed after an SFR. It's one of the most difficult things that you can do on a tax transcript, and these examples are not inclusive. There are a couple more obscure ones that are out there, but these are the primaries here. If you see the transaction 150 substitute tax return prepared by IRS, the best way to find out if an original return was filed and the date of filing is to call the IRS. I know that seems like kind of a generic answer, but honestly, most people aren't going to have my experience looking at the transcripts. They're not going to remember the exact nuances and details. Call the IRS and ask them. The problem you get into with an SFR is that once the SFR process starts, the IRS, when they accept an original after an SFR, they actually are modifying the SFR entry. They don't actually accept the return and enter the data. They're actually modifying the SFR. That's why you won't see a return transcript if the SFR process has started, because once the SFR process has started, they never generate a return transcript. So just kind of keep that in mind. Some tips to determine if an original was filed after an SFR. If the number of exemptions is greater than 1, that's an indicator. If the filing status is not singled or married filing separately, that's an indicator. The married filing separately one, I'm not 100% sure on, but I've seen 1 or 2 cases where somebody showed married filing separately and we were pretty sure that it was an original filed on it. I never heard the outcome specifically on those, but if I had to guess, I would say the married filing separately is an indicator that the IRS knows they're married and did it as a separate return, as an SFR. And if you see the transaction on the account transcript, prior tax abated, 100% of the time that I have seen that, that has indicated an original was filed on top of an SFR. Not that I think that would happen 100% of the time, just in the numerous examples I've seen, I've never seen anything to go against that. Even if you can determine if an original return was also filed, you will need to call the IRS to determine the file date. That's the challenge, is actually figuring out the exact date that that return was filed after the SFR. Okay. Early filed return rule. All right, so this comes up quite a bit. And where this comes up is you file a taxpayer under extension. And if you file before the extension, do you have 3 years from the file date or 3 years from the extension date to claim a refund? All right, and that's what this is all going to start to talk about. All right, when a document is treated as filed under the IRC, okay, early filed tax return, a tax return that is filed before the due date, determined without regard to any extension of time for filing, is considered filed on the due date. Extended due date, for example, normally for an individual, that's going to be October 15th. An extended due date is not treated like the regular due date. The filing is not considered early when the taxpayer does not use the full extension period. A timely return received before the end of the extension period, including postponement for disaster relief and combat zone, is considered filed on the receive date, not on the extended due date. All right, that's going to be important later on. But as this presentation note says, for purposes of RSED, the extension date is currently considered the original return file date if the return was filed on or before this date. So they say one thing, but then they interpret the RSED a different way. Okay, and we'll cover that more in the RSED section. Early filed return rule examples. If the due date is April 15th, 2015, and the taxpayer files on March 1st, 2015, the return file date is considered April 15th, 2015. That's why you always see April 15th show up on the account transcript on the return file date, no matter when they filed, as long as it's before that date, and in some cases, even after that date. If the taxpayer files an extension until October 15th and taxpayer files on March 1st, 2015, the return file date is still considered April 15th, 2015. The third example, if the taxpayer files an extension until October 15th, 2015, and taxpayer files on June 1st, 2015, the return file date is considered June 1st, 2015. Okay. Timely mailing rule. Now we throw mail into the mix. All right. In general, an original tax return or claim for refund that is received after the due date, including an extended due date, but that is postmarked or that is marked by a designated private delivery service on or before the due date, is deemed to be filed on the date of the postmark. Okay. A document filed with the ERO, it's going to be the date it was submitted versus the postmark. So, this actually is conflicted later on when talking about the RSED, and I'll go over those examples as well. But we're all familiar with filing of the return, how consistent that is. Okay. Now here's the other one, the Saturday, Sunday legal holiday rule. I'll refer to it as SSLH since it's a mouthful going forward. But when this document is treated as filed under the IRC, again, Saturday, Sunday, or legal holiday. In general, when the last day for filing falls on a Saturday, Sunday, or legal holiday, and the taxpayer actually filed on the next succeeding day, the tax return or claim is considered to be timely filed on the next succeeding day. Okay. The Section 7503 does not deem the filing to be made on the prescribed due date when it is actually received on the next succeeding date. For example, a Form 1040 received on Monday, April 16th, a legal holiday, is considered filed on April 15th, the receive date. Okay. And it says, see the revenue ruling that we've attached there. All right, so this one gets a little bit tricky. If you file, like this past year, I think if you filed on Monday, it was whatever the example was, but it was the SSLH rule. So even if you filed on Monday, I think it might have gone to Tuesday, it'll still show April 15th on the IRS transcript. Okay, a little bit tricky because if you do file after the 15th due to SSLH, it'll show as the 15th on the tax return or on the account transcript. However, you still actually get a couple days, but unless you're the tax preparer that did the return or know when the return was submitted, you'll never know that. Okay. The term legal holiday means a legal holiday in the District of Columbia, and in the case of any return statement or other document required to be filed or any act, blah, blah, blah. But pretty much what it comes down to is the District of Columbia. And that's why we get that one holiday that's right around April 15th. Okay. April 15th. It always falls right on or near that weekend, and it can throw things off. There used to be at the processing center in Andover, and Boston had something. I think it was Patriots Day as the holiday. One of the reasons I think the IRS moved it out of Boston, because people in the Northeast actually had extended filing days every year, so the Northeast actually had an exception to the rest of the country. I had some people, some old timers, call my dad out on that one, and some other people that said they actually knew of people that somehow would actually get tax returns up to the Northeast to get in by hand in an effort to get the extra couple days. So it's kind of funny that the little tricks of the trade have been going on for years. I'm not going to go through them all, but here is everything that the IRS lists as a legal holiday. So you have that list to refer to. The April 16th is the Emancipation Day in Washington, D.C. And if I remember right, if it actually falls on Saturday or Sunday, the Friday is the observed holiday. And that's what can throw things off if April 15th falls on a Friday. And also Inauguration Day, every fourth year, is considered a holiday as well. So, all right, here's the examples. If the due date is April 18th, 2017 due to SSLH and the taxpayer files on April 14th, 2017, the return file date is considered April 15th, 2017. If the due date is April 18th, 2017 and the taxpayer files on the 18th, the return file date is considered April 15th. This is what will show on the transcript. However, for purposes of the ACED and RSED, the return file date is April 18th, 2017, but again, it doesn't show up anywhere. You would have to have that knowledge. And I think it shows on the Mod A, but I'm not 100% sure, but just something to keep in mind. And presentation note, unless you file the return, and you won't know it, and that's what that covers there. Assessment statute expiration date. All right, so this is the first of the three statutes. It's probably the most boring, so please bear with me while we run through this one. We'll spend probably the least amount of time on ACEDs. So the ACED defines how long the IRS has to assess tax for a specific modular period. In most cases, the ACED is calculated as 3 years after the original return receive date, not postmark date unless it arrives after the due date and was postmarked on or before the due date, or original return due date, whichever is later, okay? The ACED does not start until an original return is received. An SFR is not considered an original return. Now, there was a little bit of debate that came up, and I think it's a 6020A where the IRS basically says we are going to do a SFR. If you actually sign it and acknowledge it under perjury that you accept the results, I never could find a revenue ruling that said that that does constitute the start of an original return, but there are some bankruptcy cases out there and some other things that say if you sign, I think it's the 6020A, that it would be considered an original return in some cases. If you want to do the research on it, you're more than welcome. I couldn't find it, so just keep that in mind. Now, on the other side of things, I talked to numerous people at the IRS designing the program, and I talked to numerous people that worked at the IRS, and one guy said it to me the best. And I said, how can I tell the difference between a 6020A and a 6020B SFR? One that was signed and one that was never returned. And in his case, he said, just treat them all like they're unsigned, because I never saw one in my 35 years at the IRS. I thought that was a kind of a good way to look at it statistically. So more often than not, if you don't see the original return on the transcript, it's not going to be there. So common ACED tolling events: filing an amended return within 60 days of ACED, voluntary extension of the ACED, joint return after filing married filing separately, fraudulent return, and then underreporting of tax. Okay. I don't go into the uncommon ACEDs like presidentially declared disaster areas and combat zones, but I will say this: those extensions don't take place unless somebody at the IRS goes in and actually does them. The presidentially declared disaster area, I've been working on this with the CSED and our bankruptcy product, and the only way I can figure to do the calculations is to go in, figure out what zip code was the home address, and compare it against the list that the IRS has and do it that way. I'm yet to see where it shows up anywhere on a transcript, so it's kind of one of those things. It may fall on your behalf to benefit you if you're aware of those. And I know they do list the declared disaster areas for the certain years. I found it one time. I've been trying to find it again. If I found it, I would have shared it with you. But just kind of keep that in mind. Generally, those oddballs will be on your behalf or your client's behalf. Okay. All right. If an amended return with an assessment is received by the IRS within 60 days of the ACED is extended for 60 days after the receive date. Okay. The IRS defines the receive date as the date received, not the postmark date. No exception. Apparently there is, but that's straight out of what we got from the IRS. Example, if the ACED is 4/15/2017 and an amended return with a new assessment is received on April 1st, 2017, then the adjusted ACED would be 5/31/2017, 4/1/17 plus 60 days. Presentation note, when filing an amended return near an ACED date, determine if you should wait, if tax is owed, to lessen the chance of the amended return being reviewed. It's kind of one of those debates. Why would you rush to file the return right before it was due? Now, be careful with your Circular 230. I never, ever tell people I wouldn't file if I was you or that kind of things. I present them both sides with the argument or the position, and I let the client make the ultimate decision, and then I document that in their file. All right. All right, amended return tolling. This is the statute that talks about what I just talked about. It's there for your reference. We're definitely not going to read through it. Voluntary extension of ACED. All right, a Form 872, consent to extend the ACED, signed by the taxpayer and an IRS representative prior to the expiration of the normal ACED, extends the ACED to the date agreed to by both parties. There's the IRM note. Okay. Note, a period extended by a waiver does not necessarily extend an assessment date for all situations. If you're ever in that position where the IRS is asking for this, try to limit it to a very narrow scope, because why give them access to all the different things on the position that you're taking? Just narrow it down to what they're asking for. The agreement between the service and the taxpayer may restrict adjustments to certain items. On the transcript, this appears as a 560. IRS can assess tax until. Usually an examiner threatens to just assess everything if the taxpayer does not agree to this. Remember, the scope can be limited. This also extends the refund statute date. Okay. All right, and joint return after married filing separately. I'm not going to dig into this one too bad, but basically what it says is if you have two people that jump back on they're both filed separately, or one filed and then the other one wants to join later, what you're looking at here is the ACED date will be the latest of which return was filed if there was a filing requirement. And by that, I'll go through the examples here. The joint return is deemed filing on the filing date of the last separate return, but not earlier than the due date where both spouses filed separate returns. The joint return is deemed filed on the filing date of the separate return, but not earlier than the due date where only one spouse filed a separate return and the other spouse had gross income of less than the exemption amount for the year. So if one of the spouses didn't have a filing requirement and didn't file, you're just treating the first spouse's original, the joint return is deemed as the filing date, okay? The joint return is deemed filed on the actual filing day of the joint return where only one spouse filed a separate return and the other spouse had gross income of the exemption amount or more for the year. Okay. The service has 3 years from the deemed filing date of the joint return to make an assessment. In no event, however, will the service have less than 1 year from the actually filing date of the joint return to make an assessment. Be real careful when you start combining spouses. My dad gave me the example where the CSED ended up getting extended because somebody right before the 3-year deadline for combining spouses did it, extending a CSED past where it would have expired, causing problems. So think of the impact before you do things like combine spouses after the fact. Even though it might be a little bit money to them on the front end by not doing married filing separately, as soon as you join these people, it throws that for a loop. Being a former law enforcement officer and us in taxes, just remember what a marriage really is. It's a financial arrangement between two people who may or may not love each other. It's strictly a financial arrangement, so you really need to treat, anytime you're making a financial decision about married folks, what the legal impact of things are. Sometimes marriages, for some reasons, don't get looked at as a business arrangement. They get looked at as this mythical thing in reference to taxes. My wife will kill me if she heard me say that, but I think we all understand. So, all right, fraud is forever. We've all heard this, and this is the statute that defines that. There is no period of limitations on assessment for a false or fraudulent return with intent to evade tax. The hard part is intent to evade tax, okay? An amended non-fraudulent return submitted after a fraudulent return does not begin the period of limitations. So if you think you're gonna run out and do a quickly amended return to fix the fraud, it doesn't work out. 3 didn't apply to this presentation, but I kind of listed to show you there's a 3. Right? Fraud is not covered in the Code of Regulations, but several indicators of fraud are provided in the IRM, indicators of fraud. There are 2 terms used in the fraud development process, indicators of fraud and affirmative acts, firm indications of fraud. Note, fraud does not need to be committed by the taxpayer. Fraud done by the tax preparer without the taxpayer's knowledge qualifies. That's a scary one. Think of these EIC shops that tank these returns. These people may or may not be aware, but we know they always claim to not be aware. They're on the hook forever for those years because of that. Also, there were some investment schemes with some real estate a few years ago. A friend of mine in Brunswick has been dealing with, and he said it's just been a living nightmare because of the fraud. The normal rules don't apply. And although his client wasn't gone after for the fraud, it did do some extensions because they were wrapped up into the fraud investigation, if I understood it correctly. Okay. Under reporting of tax, this is the one that is, let me send this out. So my audio is low. I've got somebody watching the presentation. They can let me know if it gets low. The 25% omission. So this is the one that plays the biggest gotcha in dealing with the ACED. All right. The tax may be assessed within 6 years after the original return if the taxpayer omits more than 25% of the gross income reported on the original Form 1040. The other one is the foreign rules there. I'm not going to go into it, but I listed it here for your reference. Got to be careful about this one. And as I designed the software, the question came up with, how was I going to calculate ACED? I went with just the 3-year rule because I can't, from the transcripts, know specifically if an underreporter is going to be for 25%. I can see 1099s and all that, could have done the math. The problem was you have to take into account the expenses, and that's something that just doesn't show up. So something to keep in mind with that. Be careful about the 25% omission. Okay, strategy for delinquent returns. All right, this is a biggie here. If an original return is never filed for a tax module period, then the ACED never starts and the IRS can theoretically go back forever. Okay, this is the great debate that I've heard it when I was an NTPI fellow. I've been at different resolution classes. So people are pretty adamant on one side of this fence, and I'll give you my feedback on it if you don't already have your own opinion set. Should a delinquent return be filed if it has been several years since it was due? Now, obviously, if there's a refund involved and no fraud, yes, absolutely file it for the refund. But this is in reference to getting more assessments. So the first position is yes, always start an ACED to limit future liabilities. The second one is no, let the sleeping dogs lie. No matter which way you come down on this, I will tell you this. Remember that it says the decision should be made by your client, and be wary of your obligations under Circular 230 when rendering tax advice. I know that's kind of the cheat answer, but don't ever, or at least in my opinion, I never tell anybody not to file. I give them my opinion as to whether or not they should file. You know, if you don't file, there's some chance out there. I never say 50, 80, 100 because they want to hold you to it, but I say there's some chance out there the IRS could come back on you. Okay. And then, likewise, I said, yes, you could file and it'll limit it, but, they may talk to somebody else and then come back on you and say, hey, I filed an extra $25,000 in taxes. And this guy said that, you should have never given me that advice and I'm going to sue you under 230. So just be very, very specific with your advice, but leave yourself enough wiggle room and document it somewhere in their file that, that you presented and they made the decision. So, I do have some people, and I know there's some people listening right now that probably took these positions, so I don't want to offend anybody, but I've seen on numerous occasions people that have come in and said, you need to file 15 years of tax returns. Well, first off, good luck finding the wage and income transcripts. Secondly, I don't know if that's good advice. I mean, and I saw the specifics of the case, and I don't know that I would have gone that route. But again, that's why we call them opinions, and that's why lawyers practice, because none of us are ever 100% with what we do. So just keep that in mind. I usually tell people I would always recommend filing the 6 years back because that's what it takes to be compliant. It also covers the 25% underreporter. And at the end of the day, I get to charge fees for doing the tax return. Now, that's not my underlying thing, but I've always been a follow the rule kind of guy. I try to steer my clients in that direction, but in the end, it's their ultimate decision. So we've got a little bit of extra time, it looks like, so I'm going to throw this out. I get this question all the time about wage and income transcripts that go over the 10 years, but I'll throw it out there. It's just a couple of minutes. So everybody asks me, what should I do if I need to do an 11-year-old tax return? The wage and incomes aren't there, but the IRS won't accept my position. I always tell people this: get a FOIA, send it to the IRS requesting all wage and income documents for the years in question, the ones older than 10 years. They're going to come back and say they don't have it in your system. You're then going to reach out to Social Security. Your client's actually going to do it and try to get as much information as Social Security has on you. You're then going to reconstruct, I always use the word reconstruct, not guess or whatever other words we use, but reconstruct their wage and income. If the IRS turns down an older return for whatever reason, during appeal, you go to them and you basically say, why did you turn down our reconstructed numbers, or our best estimate as to what's going on? Because you don't have any other information. Here's my FOIA. You came back and said you have nothing to say that I'm not telling the truth. So just understand that you're setting up your position for the appeal. So I generally don't do appeals over that, but I've helped plenty of people that have, and that argument or that position that they presented seems to have worked very well. So, all right, with that being said, kick out. I thought this one was kind of funny. The amendment filed after ACED with payment. If an amended return is filed after the expiration of the period of limitations on assessment, any amount paid with that return must be refunded to the taxpayer. The taxpayer does not need to file a claim for refund in order to receive a refund of the payment made with the late filed amended return for additional tax assessment. So I brought the question up to a couple of people I kind of trust, and the feedback I got was this: what if they owed for a different year and did this? The unanimous consensus was that the IRS will not refund that money. They will just apply it to the year that owes debt. So if anybody has any feedback on that, please send me an email. The email's at the end of the presentation and also listed on several different places in here. All right, refund statute. The best way I can tell you with reset is I've written this section 5 times in 4 months, and it is probably the most, it's even more conflicted than the CSED calculations. And the RSED has recently become more and more important, especially to some of our users and folks out there that are doing their own first-time abatement calculations, because we have a lot of people that go back into the 90s and 2000s and do first-time penalty abatements. Well, if the RSED is expired, you're not going to get a check for those years, but what the IRS will do is an offset to an open year. But if you've identified somebody that actually has a non-expired RSED and a first-time abatement, you may have the possibility to actually get a check back. So I've put more effort into actually researching and understanding the refund statute expiration date. And I almost feel like there should be an IRM or an IRC somewhere out there that I have just missed over the past 5 months of this intensive studying I've been doing on the subject. So if somebody knows where any of this is when I say I've been able to not find a specific example, please send it to me. I will add it to the presentation, make it better as I go forward. It's almost like I feel like it should be in front of me and it's not. So the RSED defines how long the taxpayer has to file a claim for a refund for a specific modular period. The RSED is calculated differently for the following situations: when a delinquent original return is filed, and an amended return is filed, or other claim for refund is made after the original return is filed. There's only a few other claims. For the most part, 95% of the time, it's going to be an amended return, okay? A timely filed original return doesn't have RSED because you get the money back anyways, okay? All right, so here's the US code. In this case, I am going to read it because it's the set of everything we're doing, and they're severely conflicted with the IRM. But let me kind of go through this a little bit. So it's US Code Title 26, whatever the documentation is for the 6511 section, limitations on credit or refund. Period of limitation on filing claim. The claim for credit or refund of an overpayment of any tax imposed by this title in respect to which the taxpayer is required to file a return shall be filed by the taxpayer within 3 years from the time the return was filed, or 2 years from the time the tax was paid. Whichever of such periods expires the later, or if no return was filed by the taxpayer within 2 years from the time the tax was paid. The rest of it talks about a stamp. I'm not going to go into that, okay? Presentation note. This IRC defines what is known as the 3-year period, how long you have to claim the RSED, okay? The next part of this is the next section, so section B. All right, limitation on allowance of credits and refunds. So this section defines the 3-year rule and the 2-year rule. Those are how much money you can get back if you filed under the RSED, because you don't necessarily get all the money back if you file on the RSED. The money is time limited, and that's what makes this one severely complicated, okay? So, 1, filing of a claim within prescribed period. No credit or refund shall be allowed or made after the expiration of the period of limitation prescribed in subsection A. So that's what I just read. And that was the 3 years from return filing and the 2 years if no return was filed. But that's conflicted. For the filing of a claim for a credit or refund, unless a claim for credit or refund is filed by the taxpayer within such period. All right, A defines what's called the 3-year rule, and B defines the 2-year rule, all right? And those we'll talk about in just a minute and a little bit easier. Actually, I'm not gonna read the IRM. I've kind of summarized these in a little bit, and let me cover them here because this part does drag a little bit. It gets a little bit hard to explain, but just bear with me. So I added this part to the presentation, and I hope this makes it click for you, all right? So when dealing with RSED, is claim an original delinquent return or an amended return? Okay, if it's a delinquent original, if it's filed after the return due date or the extended due date, if an extension was filed, then the RSED 3-year rule applies, okay? If it's amended, was the amendment received in the 3-year period, yes or no, all right? If it's yes, then the 3-year rule applies. If it's no, the 2-year rule applies. So I had the internal debate. Should I define this first and then show you the details, or should I go ahead and show you this? I decided to kind of show you the map, and now we're going to go through and define the 3-year and the 2-year rules. And if you'd like to provide any feedback that you like the other way, please let me know, because that's been trying to make this presentation better. RSED and original delinquent returns, straight out of the IRM. If an original return is received more than 3 years after the return due date, a refund offset is limited to the tax paid. Tax paid includes the interest and penalties within 3 years immediately preceding filing of the return plus extensions. All right. Presentation note. This directly conflicts with the IRS IRC 6511, the excerpt that it conflicts with, or if no return was filed by the taxpayer within 2 years from the time the tax was paid. This actually says that you can go back 3 years before the return was filed plus extensions, whereas the IRC talks about 2 years if the original was not filed, right? This is why the IRS can keep the taxpayer's withholding if they don't file an original return within 3 years of the due date. I've asked an untold number of people, where does it say in the IRC or the IRM that the IRS only gives you 3 years from the due date or the extended due date in which to make a claim for your estimated taxes or your withholding, okay? This is the closest thing I can find that defines this. Basically what it says is if you file 3 years after an extended due date and you filed an extension, you can now get the withholding back by filing on that very last day under here. Now, this says if it covers, if an original return is received more than 3 years after the return due date, nowhere was I able to find it if it said less than 3 years after the return due date. So again, this is where it starts to get confusing. I apologize, but we'll kind of muscle through this. If you ever get a case that's in question, my door is open. I can't take calls and render immediate tax advice. I just don't have that kind of time anymore. But if you do send me an email, users will get priority, but I still do consulting for people that aren't customers as well, usually for free. If it's something you require a position on, or me to call the IRS with you, that one I got to charge for. But most times when it's just looking at something and help you calculate an RSED, ASED, or CSED, I do that at no charge unless it starts to get involved a little bit more than average. Okay. The RSED 3-year period layman definition. And back to that in that previous slide about this. So funny story, I'm an enrolled agent like many of you, similar to the CPA. We sit in these classes and we hear these people talk about these wildest, crazy scenarios that we may or may not see in a 10-year tax career or even a 20-year. The biggest thing I want to know is, please give me your business card of the person that's teaching me. And if I ever get one of these cases, I'll refer it to you, because what you just taught me, I'll never retain 5 years from now when I need it. So, I kind of hope that's out there with me. If you ever need help with any of this, reach out to me, because obviously I don't think anybody's going to study or commit any of this to memory. So that's the best way to take out of this presentation. All right. So the RSED 3-year period layman definition, I'm trying to simplify it for us all. The 3-year period, not 3-year rule, is the 3-year period from the time the return was filed, adjusted for due date and extension due date. If the claim for refund is filed within 3 years of the return file date, then the 3-year rule applies. If not, the 2-year rule applies. So just reinforcing what we saw in the flow chart. Okay, this is the RSED 3-year period examples. All right, I'm going to go through the first couple of them. Actually, this one I'm going to go through all three, because it talks about the delinquent filed return and the postmark, which conflicts with what we learned earlier. So number one, a 2005 individual income tax return is received on April 18, 2006, but postmarked on April 14th. It's deemed to be filed on April 15th. Let's see, is deemed filed on April 15, 2006. A claim for refund filed on Monday, April 18, 2009 is timely. Friday, April 15, 2009 was observed Emancipation Day in DC. So the 3-year period is bailed out by the SSLH rule, okay? A 2005 individual income tax return received on Friday, April 14, 2006 is an early filed return that is treated as filed on April 15, 2006. A claim for refund filed on Thursday, April 16, 2009 is not timely filed. The SSLH rule that applies to some 2005 returns does not apply here, because the taxpayer's return was not filed on the next succeeding day. This is the one I told you earlier, that unless you know that it was filed on Monday, April 17th, you won't be able to win this argument. I don't know how the IRS's computers will interpret it in the system. I don't know if they do it correctly or not. It's one of those, it's the eclipse. Only certain people are going to see it, and only if you happen to be at the right place at the right time. So I haven't physically seen that example, so I don't know how the computer systems handle it at the IRS. Number three, a claim filed on a delinquent original income tax return that is postmarked on the last day of the 3-year period is deemed to be filed on the postmark date. So that's Weisbart. Remember that later on, because there's another thing that says that doesn't apply. Okay. Timely mailing rule. Okay. According to IRS revenue ruling, as of 5/26/2000, if a claim for refund is postmarked before the 3 years from the original return file date, but is received after, it is not considered timely filed for the claim for refund. This appears to conflict with Weisbart versus United States, which was actually later. So I would hope that Weisbart takes precedence and the postmark date would apply, but this is one of those examples of conflicting positions that the IRS has out there. It is always best to have the claim for refund delivered to the IRS prior to the 3 years from the original file date when possible. My recommendation is to have the amended hand delivered to the IRS and get a stamped copy as a receipt as proof to avoid having to appeal the decision, which may cost more than the actual refund. So whenever possible, do the amended hand stamped when you're getting close, right? Why not if you have an IRS office nearby? But just be aware, if you're going to argue this position with the IRS, don't even mention the top revenue ruling from 5/26. Argue your position with Weisbart. If they bring up the other one, say, hey, well, Weisbart should have the precedent because of the later date. Not practicing law, just a position that you're going to take in presenting your client's case to the IRS if you're a Circular 230 preparer under POA. If you're only a non-EACPA or attorney, now you're basically just going to have to guide your client and maybe help them a little bit through the 8821, but be careful you're not doing any representation there. So, all right, one more RSED exception.
Hey, Roger. Sorry
Yes.
to interrupt. Just want to make sure everybody knows that I put the second question up, second polling question.
Oh, okay. Yeah, definitely. And Mitch, go ahead and interrupt me every time the polling questions are up. That way everybody knows. So if you guys answer the polling questions to the right, or it's probably on the right on your computer. If you don't see them, fire off to Mitch so he knows that you saw it, and he can give you credit for it. So
yeah, and just one quick thing about the questions. We're not going to answer the questions till the end, so make sure you put some kind of context into what your question is and not just like a quick comment, because we won't be able to answer that because we won't know what you're talking about. So.
yeah, and one of the reasons we're waiting until the end is a lot of the exceptions that apply to ASED will also apply to RSED, and that was one of the reasons that I did it. When we did this at the Florida Society, I tried to take a couple of questions in the middle, kind of started to take things off the track. So please bear with me on that, and I'll be happy to answer any questions.
All right.
So,
and if you missed the first one, just answer the rest of them. You'll be fine. All right.
Yep, there we go. So if you missed the first question, and just do it again and get credit. So, and also for those of you that are interested, I will make the recording available upon request. I'm not going to post it on the website. I've had a lot of problems recently with people that have taken my presentations and kind of rebranded them themselves almost verbatim. So I am trying to limit that a little bit more. These are copyrighted once we technically do them, but if you do want the recorded of this presentation, I'd be happy to send it out on a one-off. If you're interested in doing a presentation similar to this, let me know. Some presentations I do make available. This one I won't be making available to other people until after the first of the year, because I've got some other commitments with it. So, all right, so processing original delinquent returns claiming an overpayment. If a late filed return does not have an envelope attached and the return is received, IRS received, within 7 days from the normal RSED, then consider the return as timely filed by the RSED. Presentation note, this only applies to the delinquent original, not an amended return. Now, with that being said, from my professional opinion in dealing with the IRS, that tells me that a lot of times they mistakenly throw the envelope away. So if you ever need to appeal this, for even a late filed normal return or something like that you're contesting, I would bring this up and basically say, was the envelope there? Remember, you can always FOIA this information. So if you're ever appealing something, even if it's not referenced the RSED, ASED, maybe it's a late filed return and you got the failure to file penalty and it was on your fault because, like all of us, we somehow mistakenly didn't get a tax return pushed up on the very last day and we found it 3 days later sitting there. Just keep that in mind. So this would be something that would be on point. If they don't have that envelope, it's something that I would contest that the postmark was under. And as long as you can present I hate calling it an argument, I always call it a position. We shouldn't be arguing with the IRS. We should be taking positions. So, all right, so get off of this one here. All right, the RSED 3-year rule is different than the 3-year period. This is the actual definition of the 3-year rule, and I'm going to read it because this one is important and it's reasonably short. The amount to be credited or refunded is limited to the tax paid, which includes tax penalties and interest, during the 3-year period prior to the filing of the claim, plus the period of any extension of time to file. So I know a lot of tax preparers out there that always file extension returns for their clients, and they think, oh, no harm, no foul. In this case, you're actually benefiting them because on a fluke, in 3 years from now, they may want to come back and file a claim for refund. They actually have an extra 6 months to get that claim filed and get, all the way back to the withholding and any estimated payments, okay? However, I have seen people get burned on the bankruptcy side where a bankruptcy attorney filed the bankruptcy not knowing that there was an extension, and it caused them not to be able to take their part of their assessed balance under the bankruptcy. So just be aware, there are consequences to filing extensions for all of your clients, just ad nauseum for everybody out there. So just be aware of that there are other things out there. Because I remember always in our franchise and practice going along, we did a lot of that. And it was always, well, there's no negative side to this. Well, there is a negative side to it. And just remember, the client doesn't actually have to sign it. So if the client didn't actually ask for the extension and maybe it wasn't your client, argue on the fact that maybe somebody filed the extension without their position, file a FOIA, and you can show them that it's maybe not in their handwriting or something like that. I know people that have done similar things and argue in it. Sorry, taking a position, not arguing. Don't argue with the IRS, but kind of get the drift. So simpler example, okay, and this is out of one of the revenue rulings I gave you in the handouts. If the taxpayer files an extension for Sunday, October 15th, 2017, and files on Sunday, October 15th, 2017, they have until Thursday, October 15th, 2020 to file a claim for refund on their withholding and advance payments. Example 2, if the taxpayer files an extension until Sunday, October 15th, 2017, and files on Monday, October 16th, 2017, they actually have until Friday, October 16th, 2020 to file a claim for refund on their withholding and advance payments. Example 1 cannot file on Friday, October 16th and still get the refund. So another one of those examples to kind of show you that filing on that very last day actually gives you an extra couple days. Okay. The RSED 2-year rule, right? If the claim for credit or refund is not filed within the 3-year period for filing a claim, the amount is limited to the portion of tax paid. The payment of tax could be for tax, penalty, or interest within the 2-year period immediately preceding the filing of the claim. Presentation note, and just a note, kind of funny, a note on a note, but presentation notes are ones I've written. Sometimes the IRS has a note under an IRM. If it doesn't say presentation note, it's actually an IRM note. I tried to differentiate between the two, to differentiate between my words and the actual IRM. So presentation note, the 2-year rule comes into play only if a claim for refund is not filed within 3 years of the original return file date. It does not apply if the original return was not filed, okay? See the next slide where we'll talk about the original delinquent return procedure, which we mentioned earlier, okay? This example is, and I've seen people get first-time abatements in, say, 2005, and they've actually gotten refunds. And why they got the refunds was they were still making installment agreements. That's where the payment was being allotted out to, was that 1 year. They didn't have any other debt, so they were able to get all the installment agreement paid for the 2 years, but that's only because they didn't owe for other years. If they had owed for other years, they would have taken the refund and applied it as an offset, okay? And let's see here. Whoops, I said next slide. I rearranged these last night. We'll talk about the other one here in just a minute. So, all right, taxpayer files a tax return and pays $5,500 of individual income tax on April 15, 2001, right? On March 1st, 2004, taxpayer pays $1,500 as a result of examination and adjustment, increasing rental income. The ASED was not extended and expires on April 15, 2004, so no tolling that we see. On May 1st, 2004, 3 years and 15 days after the original return was timely filed, the taxpayer files a refund claim for $2,000 to dispute the examination adjustment and to decrease the rental income below the amount shown on the tax return. The taxpayer may receive only a $1,500 refund, which is the amount of your tax decrease under the 2-year rule. Because they filed the 3 years and 15 days after the original return, they could only go back and get those payments made within the 2 years. So hopefully that reinforces the 2-year rule. All right, there is an IRS memo that references the 3-year rule. Let me go back to that one slide where it said on the next slide, we'll talk about the delinquent original. We had rearranged these slides last night. I missed that, so we will talk about that coming up. But right now we're going to talk about the IRS memos. So these memos were the most frustrating thing ever as I rewrote this presentation the original time back in January, and I've probably rewritten the RSED section no less than 5 times because I would find new information or bounce it off those people that are my go-to people for tax. So I'll mention a couple of those people. Jeff Long's fantastic resource, Jeffrey Schneider out of Florida, Bill Nemeth has been great, Hansley Cook out of Brunswick, and several others, if not dozens others, that I'll bounce some of these ideas off. I couldn't do any of this without your combined experience. So, but then I would find these memos, and these memos would basically throw the big fat monkey wrench into what I thought was my understanding of these rules. So the IRS released a memo on May 24th, 2013, so pretty recent, that addresses the 3-year rule as it is affected by tax return extensions. The current calculation is not correct per IRC, but due to programming system limitations, the benefit goes to the taxpayer. These are quotes from the memo. I'm not going to go through the whole memo, but here's some specific quotes. The Section 6511 rules are so complicated that the system, talking about the IRS system, cannot currently be programmed to figure out every situation. All right, so when I tell people that my CSED calculations end up being more accurate than the IRS, or my ASEDs and RSEDs tend to be more accurate than the IRS, it's a mess. They are using 1970s technology to try to accommodate not only the way the rules were written, but all these revenue rulings and court cases that have come later, and it's hard to interpret legalese into a computer program, and they're struggling with that. All right. Next quote, so to avoid claims barred by 6511B2, it is better not to have the RSED refigured to 3 years from whenever the return was filed, all right, as you rightly suggest, all right? Again, the early filed return rule says if you filed an extension, but you filed in June of that year, June should be your file date. However, the IRS calculates it as the extension date, even though the IRM says they shouldn't. Or if that deadline is extended to the earlier of the extended due date or the return received date, okay? Next, another quote. When there is an extension of time to file, the RSED should be 3 years after the earlier of the extension due date or the return received date, right? That's what it should be. That's what the other quote said it should be. But what does it say? Currently, the RSED date is set to 3 years after the extended deadline and remains at that date, even if the taxpayer files prior to the extension date. Because their computer system is so jacked up, this is kind of the reality we live in, okay? Especially when dealing with the IRS. All right, IRS memo reference current RSED calculation dispute. I've tried to read this off to people. This is a great example. Go through this later on. Kind of go through it and sit. This will kind of be your own self-quiz after the presentation to see if you understand how the IRS is currently calculating RSEDs. I've read this off to people. There's nothing I can do to really explain it in this presentation, but treat this as your quiz afterwards. Kind of go through it. I will say this. In their example, they talk about sends $500 with an extension, but they never, ever address that $500 in the answer at the end. So don't try to rack your brain on where that $500 is in their example, because they say they send $500 in with the extension. Well, the extension has to be in before the due date, so presumably that $500 would have to be prior to April 15th. But on the answer, it says he cannot get back the $1,000. In my opinion, he would be $1,500. Now, if he sent it in with the extension, that's a different ball game, but they don't talk about the $500 here, and they talk about another amount he sends with the extension. So that $500 is lost in your answer, but if you have any problems and still don't understand what I'm explaining after you've looked at this, fire me an email and I'll review it with you, and either myself or Laura Thompson. All right, extension of RSED. All right, so these are the extensions. I'm not going to spend a lot of time on them, but number 2, the period for claiming a credit or refund is extended until 6 months after the expiration of consent. So remember that thing we talked about in ASED where you could do a voluntary extension? That also extends the RSED. So if you give them more time to assess, even if it's limited scope, you've now given yourself the time of the extension plus 6 months on your RSED. So, but again, if you don't look at the account transactions to see that, the IRS does not calculate that in their system as far as I can tell. And the RSED extension example, the original return file date is April 15th, 2012. The ASED and RSED are the same date, April 15th, 2015. All right, on April 1st, 2015, and I'm sorry, yeah, that's right, the extension dates are 3 years later. Number 3, on April 1st, 2015, the IRS and taxpayer agreed to an extension by signing a Form 872 through January 1st, 2016. The RSED now becomes July 1st, 2016. Because it's 6 months after the extension. All right, so I hope that explains that. The uncommon RSED tolling is the presidentially declared disaster area and combat zones are the biggest one, but there's these other ones. I'm not going to go into them because you literally could spend 4 hours, and if you have any of those anomalies, they're there. I don't see them a lot, so it's one of those we would kind of be wasting our time to cover them, but be aware that they exist. So now that gives us the remainder 35 minutes or so to cover the CSEDs, which I think is kind of my favorite and kind of the one that I think most people are interested in based on the previous presentations. So the CSED defines how long the IRS has to collect tax for a specific assessment. The CSED is calculated as 10 years after the assessment date. Each assessment carries its own CSED. So when you're calculating CSEDs, you have to calculate it for each different assessed amount, okay? The CSED can be extended by tolling events. The IRS CSED is inaccurate at least 40% of the time there is a tolling event per TIGTA. Also, Jeff Snyder just sent me another example that they didn't cite in that research about why pending installment agreements make the CSED longer than they should be. So, and I always will get people that will either use the software or I'll help calculate a CSED, and I always get the call, program's broken or the calculations are wrong, my CSED doesn't match the IRS. That's correct. I expect them not to match at least 40% of the time, and honestly, I expect mine to not match close to 60% of the time because I think that's more or less where the lines are. A CSED event with a toll or a CSED with a tolling event, I think is miscalculated quite a bit on the IRS's behalf. Okay, the CSED section, substitute for return. So this is where we talk about that SFR. Okay. All right. The service has authority to prepare and process a tax return when a person fails to file a required return or files a false or fraudulent return under authority of IRC Section 6020B. If the service processes a tax return prepared under the authority of IRC Section 6020B, the assessment date will start the period of statute of limitations for collections. So anybody that'll present the argument that SFRs do not start the CSED, that is a specific quote that says, well, you're right, the SFR doesn't, but the assessment does. So hopefully that puts that to rest. I'm not going to read this all, but the summary is 40% of IRS CSEDs with tolling are inaccurate. According to the TIGTA report, recalculations of the calculation statute expiration date were not always accurate from September 16, 2013, reference number, and there you go. And they did a statistical analysis and found a lot to be wrong. A lot of it was with bankruptcy and tax court, but I can tell you there's some other problems out there as well. The biggest reason I believe is 80%, and this is a Roger Nemeth guess of knowing what I know about transcripts, but probably 60 on the low end of the guess, but upwards of 80% of the transactions entered on an account transcript are manual entries. So don't always assume that the IRS got the dates right on the manual entries. That's something that you may want to find from other sources. If you ever want to find out what day tax court or a bankruptcy was filed, there's something called the PACER system that will actually show you the details of the case filing that you can go to. Sometimes bankruptcies don't show up on account transcripts, hence they wouldn't be calculated on the CSEDs. If you want to see, go that extra step, it's $1 million case, PACER is a great resource for you to find out. All right. So denied ARs are adding an extra 15 tolling days. So this is the chief counsel ruling. I'm not going to go through the whole thing. It's one of the attachments, but the highlight is, and this is a quote from inside the actual chief counsel ruling. As you noted, however, when a revenue officer follows the instructions in the IRM and reverses, and those codes indicate a pending installment agreement, 45 days after proposed installment agreement is rejected, the resulting CSED computation in IDRS is off by 15 days. The IRS basically says 15 days after a installment agreement is rejected, that they have to enter the cancellation. But it says there should only be a 30-day extension to the CSED after the rejection for appeals. The reason the IRS says wait 45 days later, they're not saying enter 30 days later, they're saying wait 45 days later, because maybe you mailed it and they're giving you 15 days for them to receive it, and it may be postmarked before the deadline, in which case they have to honor it. But a lot of these things are hand entered as 45 days late. And I, for the life of me, did not know why a lot of my CSEDs were off by like 15 days, 30 days, because I went through them with a fine-tooth comb. I went through the Mod A. I was right. I knew I was right. And this, I think, is it. So an extra thank you very much goes out to Jeff Snyder out of Florida. He's the one that forwarded that to me, and that was fantastic. So here are the common CSED tolling events. We have the OIC, the installment and or manual billing, which to me is not that common one, but it's listed as the common ones. Military deferment for the military. tax court or IRS instituted litigation, bankruptcy, collection due process, waiver of extension of date collection statute expiration date, the CSED, pending installment agreement, and terminated installment agreement. So with this waiver, I don't have a slide on it. I kind of wish I do, but the cases are actually getting low. There's less than, I think, 500 of these now in the inventory where the IRS extended the CSED years ago, 25 years in the future. My dad actually saw one recently, and 2 other users have notified me that they've seen it. The IRS shouldn't ask for 25 years in the future as a routine method. They can still convert an assessment to judgment and do the 25 years, but they used to do it as a blanket all the time. And Taxpayer Advocate actually has some information out there on how the IRS should get rid of these. What's crazy is the IRS is able to go through their system. They can actually identify who these people are and correct them, but they started out over 1,000 at one time and have got it to, I think, less than 500, but they still haven't fixed them all. So pending installment agreement is probably the trickiest one we'll talk about, and a terminated installment agreement. Okay, so the 550 manually adjusted tolling event can be for any of the following: the Form 900, assets in custody of the court; bankruptcy, incorrect CSED computation, they'll then manually enter it; judgment, so when they take the assessment to judgment, they calculate it there; a TAO, military deferment; offer and compromise, incorrect CSED computation. So this is when they didn't do the CSED calculations of starting in incorrectly and they have to go in and fix it. Wrongful seizures, and taxpayer living outside the U.S. and other collection due process. Taxpayer living outside the U.S., they don't check it on most cases. They've recently started to talk about maybe banning the passports, but the revenue officers and examiners do have access to the State Department. They can actually inquire with the State Department and ask if somebody's out of the country, when they left, and when they came back. So be very careful with your clients that are leaving the country. Most times the IRS becomes aware that your client has left the country because it's a question on some of the collections forms. Do not lie on those forms, but also be advised if your client doesn't put them down, the IRS can find out if they call the State Department. So keep that in mind. All right, what the Form 911 exception is, all right? IRS IRM 5.1 blah, blah, blah states, Taxpayer Advocate Service does not have to input the appropriate IDRS code to reflect the suspension of the statute of limitation under IRC. This means the IRS does not have to enter the Form 911 tolling event, but they still can. If the IRS enters the tolling event for the 911 and you would like to appeal, the best avenue is with the Taxpayer Advocate. It is rare that this tolling even is applied, so your position should be claimed under the Taxpayer Bill of Rights, number 10, the right to a fair and just tax system. Why is my client singled out? For example, you get a client who files for the Taxpayer Advocate assistance, and the IRS goes ahead and tolls for it. Okay, but you've got 20 other clients you've done this for and they don't toll. So the question comes up, why are they doing it for all these other people? My client has reached out for assessment. Yes, the IRS can do it, but why was my client singled out? It is a valid argument if the IRS gets away from doing something, because one of the things is that the tax code will be applied equally to all. So if you can present your argument that, you know, 20 other cases of this, they've never happened before, this one client comes around, why are they being singled out? Okay. I gave that advice to LG Brooks. We had talked about this and told him this. So he filed the Form 911 on a case that was getting close to CSED. And he came back and goes, that joker went ahead and tolled for it. So the big word here is usually this doesn't toll, but it still can toll. Okay, so just something to be aware of. It's out there. And then this is the TAO exception where they actually talk about it in the IRM. Number 2. Yes.
Sorry, Roger. I'd put up the third polling question, so I'll be up there for about a minute.
All right, third polling question. If everybody wants to answer, if you don't see it, just fire off to Mitch that you're having problems with it, and he'll get you taken out. So.
Yep.
All right. So, due to systematic programming limitations, the commissioner decided in November 2003 the Taxpayer Advocate Service does not have to input the appropriate IDRS codes to reflect the suspension of the statute of limitations under IRC 7811. Okay. So he basically says you guys don't have to because you really don't have the ability to do it. They would basically have to have somebody in another department add these. And in my experience, if there's any former IRS people out there, I don't mean to offend and any of that, Jeff Long specifically. But if you tell an IRS employee they don't have to do something, most of them won't do it. So I think that's why you don't see a lot of this out there. And again, it has to be usually the revenue officer or maybe an examiner that would come in and add this in. So, all right. Uh-oh, there we go. Let me make sure I didn't go too many slides. My clicker stopped working. All right, the equivalency hearing as a tool, all right? So although the IRS tolls for a CDP hearing if the 30 days after notice expires, the taxpayer still has a year or a year and 5 days if it is a lien notice to file for an equivalency hearing, okay? The equivalency hearing does not toll the CSED. For the most part, the IRS does treat the equivalency hearing like the CDP and does not take collection action, but they are not prevented. Okay, be careful. Sometimes the IRS enters an equivalency hearing request as timely filed CDPs by mistake. I had somebody call me up that said they waited 2 days after the CDP and they mailed it or faxed it in or did something, and the IRS actually put it in as a timely filed CDP. He had to call them up and go, no, I didn't want the CDP. I wanted the equivalency hearing. It's kind of hard to explain to them you want the equivalency because it doesn't toll because you don't want to tip your hat that you're trying to get to the CSED. And as we all know, if you can get to the CSED, that is the easiest way to solve a case. And I can tell you, I've been calculating CSEDs for 2010. We've had it on the software now for since 2013. We've been doing the CSED calculations. I have seen some exceptions to my logic, but for the most part, it's been dead on, and it's amazing how many times the IRS is off on their CSEDs. There's no greater joy than running a case on the IRS and realizing the CSED is 2 years shy of what the IRS thinks it is, and you basically resolve the case just by getting to a CSED the IRS didn't know was even getting close. You can generally make significant money because it's not a lot of work on your behalf on most cases. You'll have to appeal the CSED, and we'll talk about that in a minute. All right, currently not collectible does not toll the CSED. Although in my dad's opinion, Bill Nemeth, he speaks all over the place, he thinks eventually the IRS will catch on to this one and make it a tolling event. But I don't know that it's listed anywhere and to where they could make it. It would probably take a legislative action or something significant in order to make this a tolling event. But having your client placed in currently not collectible is a great strategy for reaching the CSED without active collections taking place. The IRS is not barred from collections, so the CSED does not toll, but they do not enforce collections during this period. The IRS usually requires a taxpayer to reconfirm their CNC status every 2 years. May not be the best solution if the CSED is greater than 2 years. Okay, if it's greater than 2 years, at some point you're going to have to come out and let them know. And I had somebody recently show me an example where somebody ended up getting a large sum of money from something. They were in CNC, but they were going to be out of CNC for up to 6 months, and they were worried about the IRS becoming aware of the money that came in. I don't know how it turned out. I'm not going to give any more details, but it was funny how it fell in just that window, and it was a significant amount of money. So that's where I like to strategize with people on what the different options are. And again, I never give direct guidance. I'll tell you, this is what I would probably do, and this is the strategy I take, but this is your other options, and this is the downside to it. Let's see how we're doing on slides and time. Yep, we're doing good. So pending IAs that are not accepted or rejected do not toll, all right? So pending IAs are kind of the tricky point with calculating CSEDs from just an account transcript. The rejected installment agreement doesn't show up on an account transcript, only on the Mod A, but many times they don't qualify. So I'll start going through the pending IAs. Pending IAs are a challenge. In my experience, if the pending IA is not closed, it does not toll. Oftentimes, someone at the IRS places the pending IA on the account, but nobody ever follows up. It is never accepted or rejected, and it just hangs. All right, I have seen CSEDs expire with open pending IAs on them. I think because a pending IA shows up as an other transaction code, which is a 971, it just doesn't act like a offer and compromise that opens. It always has an end to it, or it should always have an end to it. But if it's open, that CSED will keep extending, and I'll call it what I call an open CSED. I can't calculate the CSED because it's continuing to actively toll as of today. With a pending IA, I've seen a pending IA hit. It's been a valid pending IA, but it didn't toll until there was an ending applied to it. And I'll talk about that just in a minute. So, and I've seen cases with 5, 10, even 15 pending IAs on them, never rejected. They never added any time to the tolling, so they just kind of timed out. So be real wary when you're doing a calculation on a pending IA that's coming up for a rejection. Now, an offer in compromise, they have to accept, I think it's within 24 months, or it's automatically accepted if they haven't denied it or accepted it. Pending IAs aren't, but there's language in the IRM that I've seen, and I tried to find it this morning for the presentation, and I couldn't find it in time, that it says something along the lines of a pending IA, or an IA should take something like 90 days to determine if it's a valid IA. All right. It never says you have to, but that would be your argument if the IRS left a pending IA open. All right. What makes a pending installment agreement a tolling event? Now, here's the good news, and I've been helping people with these recently. So there's 4 things that need to take place for a pending IA to even be added to your account. So Jeff Long, former revenue officer, has taught me a lot about the IRS, and one of it is they get into these procedures where they just move along as the status quo, but they don't look at the devil in the details, right? So a lot of ROs and examiners in some cases, mostly ROs or collections, will throw a pending IA on real quick because they had a brief discussion with the client and they know it tolls, okay? However, the IRS defines what must take place for it. So, all right, this is what defines if it should be a pending IA that tolls. Taxpayers need to provide specific information for installment agreement requests to be processed. Also, if the information in A through D below is provided, but is determined that the agreement request was made to delay collection action, accounts should not be identified as pending in pending installment agreement statuses. To identify accounts as pending installment agreements, taxpayers must. So if you're going to contest a pending installment agreement that's already on an account transcript, number 1's a given. Provide information sufficient to identify the taxpayer. Well, if it's already in the account transcript, they know the name and the social, so that one, there's not much to contest to. And I do recommend that you do get a FOIA if you're going to contest a pending installment agreement that may have gotten rejected after a year or 2 years or even 3 years, to argue the details of it and try to get it removed. Number 2 is identify the tax liability to be covered by the agreement. So the IRS must prove that the taxpayer, not the IRS, knew what the liability was. So if the notes on the IRS end don't talk about the client knowing or the taxpayer knowing what the tax liability is, they haven't met the 4 things for the pending installment agreement. Propose a monthly, number 3, propose a monthly or other periodic payment. They can't just say, hey, I'm interested in an installment agreement. Oh, I owe $10,000? Let me think about that. That does not reach the criteria of a pending installment agreement because they did not give you the specific amount, okay? Now, number 4 seems to be the tricky one. Be in compliance with filing requirements. How many times has a client not been in compliance, pretty much considered filing a tax return for the past 6 years, if required to? If not required to, then obviously it would be noted. But I've seen some pending installment agreements where they weren't out there. In the language below this IRSM, there was something that I didn't get into the presentation that talks about if somebody's not in compliance, then you can still do the pending, but they should be in compliance within the next 60 days. So that would be if an RO was working with a enrolled agent, CPA, or attorney under POA, and they said, hey, we're getting ready to file the returns. They're right here. Can we go ahead and get the pending installment agreement? You're about to hit levies. Let's get this taken care of, all right? So it's out there. But there's a back-end response to that. If this is still open 5 years later and the IRS decides to toll it and extend your CSED, then I would argue the fact that, yeah, they never got in compliance. However, that is a requirement for the pending installment agreement, and that is your position, not your argument, okay? Here are some examples. I'm not going to go through all of these because it's just going to be me reading, and me personally, I'm one of those people, if somebody just reads a bunch of stuff, it doesn't stick in. This is kind of for your review later on, but it talks about the examples, all right? I do want to go over a couple, and these are the do, all right? And these are from the IRM, situations that do result in identification of a pending installment agreement, okay? I'm going to do the ones that do not. So example number 1, revenue officer evaluates a taxpayer's CIS. The taxpayer's name, social security number, and balance dues are all known and are identified. The revenue officer informs the taxpayer that a $1,500 per month installment agreement is appropriate. Taxpayer doesn't respond. It's not a pending IA. Okay. Example number 2. Revenue officer mails a 433D with the taxpayer's name, SSN, and balance due listed to a taxpayer. The 433D provides a payment amount based on an analysis of the taxpayer's CIS. No responses received by phone, fax, or email, nor other communications from the taxpayer. Doesn't count. All right. Number 3, and then the rest you can look at. They get into a little bit more complexity. Right? A taxpayer who knows he owes taxes tells his employer to send $500 per month of his paycheck to the IRS. The taxpayer does not communicate with the IRS. The taxpayer's employer sends $500 per month, referencing the taxpayer's SSN. Note, if $500 per month is being received, contact should be attempted prior to taking collection action. So if you're just sending payments in, that's saying they should call prior to doing a levy or something, but it doesn't meet the threshold for the pending IA. And then there's some more complicated examples down below. So, all right, how to confirm a pending IA met criteria. All right, so let's see how we're doing on slides and time. All right, so we got less than 10 slides and we've got 15 minutes. All right, perfect. Complete a FOIA request for the pending IA in question. Ask for all documentation in regards to the pending IA to include all notes in the IRS system, as well as any written documentation or forms submitted by the taxpayer. Okay. If the pending IA was initiated by examinations, they are required to send a Form 3177 Notice of Action for entry on master file to collections. So apparently, exams is unable to input the transaction codes necessary. The Form 3177 should have enough information to establish the pending IA is valid. If it was sent from exams to collections and there is no 3177 on file, I think you got a valid argument that the pending IA needs to be removed. And I'll show you the example why you may want to contest pending IAs on one of the next couple slides. But verify from the FOIA information that the IRS documented the requirements as specified in that previous slide, or IRM 5.14.1.3, specifically the proposed payment amount, and that the taxpayer was compliant at the time of the request for IA. If the requirements are not met, try to get practitioner line to assist. A practitioner can also file an OIC doubt to liability after the modified CSED passes. Right? Since you're going to be doing the CSED contesting anyway, maybe do the OIC doubt to liability, but you can also do taxpayer advocate as well. That may be a good resource, but be advised that has the potential to toll as well, and so does OIC doubt to liability. All right, so this is my example. This is an actual where one of my clients had called me. IRS personnel abusing pending IAs. So I participated in a case recently where a revenue officer denied a pending IA that was on the transcript for over 4 years. This extended a CSED that was about to expire by 4 years. The notice of intent to levy was delivered 2 weeks after the pending IA input on the transcript. All right, so big problem there. The client was also levied after the notice of intent to levy. The tax pro filed with taxpayer advocate and advised the client wanted their levied funds back or remove the pending IA tolling event and let the remainder of the assessed amount to drop off because the CSED was pretty much passed. So what the person did was they called up and said, look, we can either start from scratch because you took collection action during an active tolling event. Okay, the notice of intent to levy went out after the fact, after the pending IA was put in the system, right? Secondly, the revenue officer that did the rejected installment agreement was not even a part of the case 4 years before and had only been on the case for the past couple months. So the theory was, between me and the practitioner, was the RO just needed to extend the CSED. That was his workaround in the system. It got the case extended and off of his, forget what they call it, and I kind of wish Jeff Long had audio. He'd probably send it to Mitch. But there's something that happens when you get within a certain time frame of assessment dropping off. You start having to work them more, and you got to deal with your supervisor. So I'm sure the fact that you could extend the CSED, it helps you manage your cases a little better. So in this case, what the IRS said was, we agree, we'll let the bygones be bygones. We're not going to give you the levied amounts back, but we'll treat it like it wasn't a tolling event since we actually took collection action during it, and we'll let the remainder of the balance drop off. And I think it was over 50K. So it was significant for him. And he ended up charging a decent amount on that case. And that was all the work that he really did. Now it was, I say all the work, but the work was well under 5 hours with what we had to do. We did most of the work when him and I sat down and went through the transcript and looked at the CSED and the Mod A. and then came up with how we should respond. So that was definitely a win for someone on our side. So calculating CSED tolling events. This is pretty straightforward, but a lot of people have trouble with this. ACED and RSED tolling events are extensions of time. CSED tolling events have start and end dates followed by additional tolling days to account for denial of appeals. And I will apologize for this. When I listed off all of the tolling events, I now wish I had a second slide that actually told you how many additional days are on there. I'll work on it on an upcoming presentation, but there are additional days if some of these things are rejected for appeals. And a bankruptcy always has an additional 6 months after the bankruptcy, unless it's been reversed. So example on this one, if an offer in compromise is submitted on January 1st, 2012, and is rejected on June 1st, 2012, the tolling event tolls the CSED for 152 days, plus another 30 days for the appeal for a total of 182, okay? And that's just a very simple example. Okay. Now, what happens if the tolling events overlap? If 2 or more tolling events overlap, the days in the overlap are only tolled one time. Okay. And I have a great visual. I hope this helps. So this is how tolling event calculations work. This is 3 different tolling events that overlap. The CDP starts things off. The bankruptcy goes from the middle of the CDP to past the pending IA. So I show the start date and end date in the graph down here. And just real quick, this is basically how our software will show it. It shows it in a little bit more detail, but it breaks everything down for you in that way that you can understand how each assessment is affected. It gives you a great way to present this to the IRS, because if you're ever contesting a CSED, an ACED, or an RSED, if you whip something out on a spreadsheet or just send them an email or write something up in a Word document, that's one thing. But when you can actually show them you calculated 25 years of CSEDs, every year is broken down, it's accurate, it's concise, you're more likely to win the argument each and every time. So the CDP tolls from the start date until the end date. Okay, the bankruptcy only tolls from the end of the CDP until the end, till its end date. The pending IA does not toll because it overlaps completely with a previous event. So because this one is wrapped under these other 2, it doesn't add anything to the days tolled. So the CDP tolls for 427 days, and it's 427 days long. Now the bankruptcy is 609 days long, but only 394 days are applied to the tolling because the others are overlap, and the entire 426 days are not applied to the bottom line tolling. We're actually looking at being able to add a graph like this for each and every CSED calculation on our CSED calculations on kind of the deluxe product for those out there. But we'd like to get it to where you could actually go to the IRS and show a graph for each tax year that looks like this, that puts the actual dates and tolling events into a visual. That's subject for 2018, but that was me playing around with this, which gave us this. But I think that would be able to position your argument very well. All right, the challenge in calculating CSEDs from the account transcript exists. So it is impossible to 100% of the time calculate CSEDs accurately only using the account transcript, and this is why. Tax court, bankruptcy, and CDP all are indicated on the transcript with the transaction 520, bankruptcy, or other legal action filed. CDP will have the collection due process request received timely, okay? It is usually impossible to distinguish between a bankruptcy and tax court from the transcript alone. Occasionally, a bankruptcy payment will be listed, but only occasionally. So for software purposes, I can't assume that a bankruptcy is 100% bankruptcy, but over 95% of the 520s that aren't CDPs are bankruptcies. So I always calculate it as a bankruptcy. It actually extends the CSED an extra 6 months. If you're ever going to contest a CSED, I always recommend you extend it as long as possible before you contest it. The only time you don't want to wait, a month, a 2 month, 90 days, 6 months is if your client's currently getting levied and the CSED expires. All right, the next set in the challenge of calculating CSEDs, and it looks
Sorry,
like
Roger.
Yeah,
last question's up.
All right, if everybody gets, if he can't respond to it, maybe let Mitch know on the chat box, and he'll take care of it. So pending IAs are extremely challenging to determine accurate tolling. The IRS does not have a transaction code for rejected installment agreement. They have a closing code, but not a transaction code on the account transcript. I have reviewed multiple Mod A's and have trouble finding the rejected date in there as well, and have reached out to some of the people I mentioned to you before, and we've had trouble finding what the actual closing date of the rejection is. On the Mod A, the closing code 043 will appear. And you saw that example previously when it talked about in the IRM about the pending IA having the 45-day extension. Oftentimes, the IRS pending IA should never have been applied because they do not meet the rules, and we had already previously talked about that. Okay, common avenues to appeal a CSED. Call the practitioner line and bring it to their attention. That if you ever Google that article, I didn't do it as a handout because it's, I think, 35 pages long. It's the 40% of, TIGTA says 40% of CSEDs are incorrect. There is actually a unit in Memphis that calculates CSEDs. Okay, so when you call the practitioner line, there should be a way for them to get you to Memphis to calculate your CSED, but a lot of times I've heard from our users that practitioner line will say, no, I don't know how to do that, and hang up on you. They actually have something called CCalc, C Charlie Calc. It is an IRS Excel spreadsheet they use to calculate the CSED calculations. I have heard from one IRS person that has used CCalc and used our CSED calculator, and they said ours does a much better job of calculating the CSED. So I was happy to hear that. I would love to get the contract with the IRS to do both their bankruptcy and their OICs, but so far, no go. So anyways, file a 911 for the Taxpayer Advocate's Assistant. That's a great tool, but be advised that does toll it. So it's kind of funny, you're appealing a CSED, but you can also extend the CSED while appealing it as well. And the final solution, I think, in your arsenal should be file an OIC doubt to liability, but only after your CSED has passed. And even then, wait at least 90 days if possible, just to make sure. And it goes without saying, if you're this close to a CSED, I love looking at these cases because I get real-time, near-future feedback on how the IRS calculations differ from ours and how we can use it as a tool. So, all right, that's pretty much it. Questions? I'm fixing to open it up to Mitch. I'm going to go over this. That's contact information. Additional free information can be found at taxhelpsoftware.com and auditdetective.com. Auditdetective.com has a lot of resources about how to read transcripts and that kind of thing. And even if you don't use the software, on TaxHelp Software and auditdetective.com, I have resources in a lot of my old presentations and even my dad's presentations on like first-time penalty abatement. They're located there as well. You don't have to be a user to access any of the free materials. It's there, use it. I will answer questions whether or not you use the product. You'll just get priority, obviously, if you're a customer. Currently, I'm on the road doing shows for the next 4 weeks. I'm going to be in Nashville tomorrow with Michael Rosbrook, IRS Forum next week, and then the IRS Forum in Vegas the following week. So email is going to be my best resource. I just noticed I didn't list my email, but you can contact us at the info@auditdetective.com, and all that contact information is on taxhelpsoftware.com, or you can reach out to Mitch and he'll get it to us. And hopefully the only plug I'm doing for the software, because I try not to plug software while I'm doing it. If anybody does want to try any part of the products that we have out there, use THS Trial. It's case sensitive, all capitals, and you're welcome to try either the executive, the bankruptcy product, the Pro Plus, if we can be any help, let me know. If you're interested in getting into e-services, we have a whole webpage at taxhelpsoftware.com on how to get people signed into e-services. So without further ado, Mitch, if you want to pitch the questions to me.
Yeah, sure. I guess we got time for a couple questions. Yeah, Roger, there's a couple of people asking about Nashville. Yeah, so that's the marketing event by Michael Rosbrook. Actually, Larry Lawler and I will be there, and Roger will be there, and I'm sure some other people are going to be there, so that should be cool. But the first question is, can you please review filing changes with the IRS offices no longer accepting returns at local offices?
Yeah, and when I wrote the presentation, I had kind of pitched that around. Some people said that you can still go in and file a return locally, and I believe what that is some of the IRS offices have requested appointments. That's a tough one. If the local IRS won't take the return, I would document that they wouldn't take the return and you were trying to file the return, and as a backup, do the certified copy to the IRS. If there's a problem, I would appeal it through that avenue, and that the local IRS office actually bounced you out of there. And you know, with your cell phones now, I'd even take a picture. They timestamp for the most part and basically say, here I am. I was told no. Try to get something in writing about doing an appointment at the IRS. And some people still can get into their local offices and some people can't. So I don't have any other information on that, but that's what I would do. If they bounce me at the last second, I'd do a certified mailing, but I document that I did try to go to the actual office itself and they actually turned you away. And I think you'll find success in appeals with that.
All right. How do you request a tax mod A, and what other tax mods should be requested?
Tax mod A is the big one. I know there's some others out there, but tax mod A is really the one that would have the other information on it. It actually has the CSED in some cases. There's another screen out there, and I think it's under the mod A, and I'm not real sure how the IRS system works because I haven't been able to play around with it. The mod A actually has a subsection on it that actually show the CSED for each assessment. And sometimes the IRS gives you the wrong CSED because they're giving you the longest one or the biggest one. But if a client got, say, $1 million assessment 11 years ago and a $25 assessment 3 years before the current date, you're going to see the CSED for the $25. Who cares about that one? I want to know about the million. So just know that, especially with the IRS people retiring, trust the information in front of you, and you know, sometimes you just got to hang up and call back. But the mod A, generally you get it by just calling up. I used to hear that you have to do FOIA requests, but for the most part, most everybody I've talked to has been able to get the mod A just through a phone call. The ROs sometimes are apprehensive about it, but hang up with your RO and call the practitioner line and ask for it on practitioner line. Most people I talk to said they get it just by calling. If they're really stonewalling you, then do a FOIA request and document that the IRS isn't giving you the information. So if you've got other things you're having trouble with, that's just one step in the process of, you know, you guys have been nothing but a barrier. I had to wait on a FOIA request for 6 weeks to get a mod A. That's ridiculous. And also, if an RO won't give it to you, send him a copy of the FOIA as well. And say, hey, we just FOIA'd it. So you can either give it to me now or later. And by the way, it's your supervisor there. I want to make sure they have a copy. So that would be my best recommendation on the mod A's.
All right. Let's see. Does CSED also get told for innocent spouse?
Innocent spouse is one of the things that it will toll for. And you're right. I don't think it's listed on there. I think it's one of the others. I'll double check, but yes, innocent spouse will toll.
Okay. Let's see. I was told that tolling only occurred on an installment agreement if the taxpayer or representative asked for an installment agreement. If the IRS offers the installment agreement, then should there be no tolling?
The 4 points are that you have to know who they are. So if it's on the transcript, the IRS already knows. The taxpayer has to be aware of what the total debt is. There has to be an offer, and they have to be compliant. So if the IRS doesn't have those 4 things, then it should not have been a pending installment agreement, and I would contest it. And the instructions on the order of how I would contest it and take a position is listed in the presentation.
All right. Let's see.
While you're doing that, I want to go back to the slides on the tolling events. I want to see if it has innocent spouse. I thought it was under the other, but let me see. It's kind of an oddball one, and it may have missed. But go ahead. You can go ahead with the next question.
Okay. Can you go over the filing of an original return for? I'm sorry, I'm having trouble reading this.
I had trouble learning this, but go ahead.
Can you go over the filing of an original return for a refund when filing an original for an SFR? The SFR does not start the RSED.
Yes. All right, let me do this first. I actually have a slide on that, but let me see here. Yeah, innocent spouse. It's funny, I actually copied these off of the IRS website, the TCs and all that, and innocent spouse. Yeah, innocent spouse should be on here and didn't show up, so my apologies. I'll get it added. It should be under here, under the manually adjusted tolling events. It may have just bumped down and got bumped off the slide, but thanks for catching that. Innocent spouse is a good one, and it does toll. It's got some funny tolling rules in it. If you get one, please let me know, and I can help you go through it. There's 3 different rules on how an innocent spouse ends. And then your question was let's go back to the RSED. And what we're looking for is this one. So it doesn't matter if an SFR was filed or not. It's just let me find it. I'm going through the slides. There you go. It's this one here. It's irrelevant whether or not an SFR was filed before the RSED before the original delinquent return. And again, a delinquent return isn't one that's 3 years late. It's any return that's after the due date of the return or the extended due date. So what it basically says is if you don't have an extension and you file it anytime after the due date, you can go back 3 years to get any tax paid, and that includes interest and penalty. If you filed an extension, you can go back 3.5 years. But most payments show up, any payment made before the due date is generally considered made on the due date, not made on the extension date, but made on the due date itself. So as long as you file an original return, and if you have an extension, you can actually file 3.5 years in the future. So for 2017, let's say for filing for 2016, so this past tax year we just filed, if you have your client under extension, but you never file the return, you have 3 years from October 15th in order to get your withholding and estimated payment amount back for that year. Does that answer your question?
I don't know. I can't talk to
Oh, okay. But anyways, it's this slide right here. That was probably as simple as it kind of looks now. I've seen some conflicting stuff on that. IRC says if no original returns filed, you only get 2 years, but I'm kind of going on based on what the IRS actually does and the fact that I found this and it supports it. So hopefully that answers that question. And let me just say, we're definitely over the hour and 40 minutes. So if anybody out there doesn't want to answer any questions, and as soon as we're done with questions, I was also going to run through for either existing users or anybody that had questions about the Tax Help Soft product, completely optional, not trying to make anybody sit through it and watch it. I'll be available at the end on the webinar to kind of go through the software for, again, just a quick demo or if anybody's got any questions about the product. One of the new features we just came out with is we actually allow our users to convert wage and income transcripts back into the original forms. So if you're tired of having to do prior year returns and extension returns on wage and income transcripts, follow the line with your finger. We actually convert W-2s back into W-2s and 1099s back into 1099s. So just one of the things I'm going to cover here in a minute, but go ahead, Mitch.
All right. How about 2 more, and then we'll go on and wrap up the presentation, and then you can show them all a demo of your software. Okay. So what is the utility of the tax mod A when the software calculates the CSED, RSED, and ASED?
Okay, so great question. So when somebody comes to me and says, hey, the CSED is, your software says the CSED is this. If it's reasonably getting close within 2 years, or if it's a big dollar case and it's maybe 3 or 4 years out, there's a procedure I tell people to go through. The first one is to get the Mod A, okay? And the reason for that is, let's see what the IRS number is. If the IRS only has one CSED listed, I would call up and say, hey, I'm trying to get the CSEDs for the following years. But be careful by doing that, because you can wake up a giant by saying, hey, what's the CSED on this $1 million case? Oh, it's in a month? Thank you. If you call the practitioner line, that can alert the IRS. They can actually send something for review up the chain. So be careful about that. But you could also do a FOIA request for the CSEDs. Generally, the FOIA request will go through the FOIA office. And quite frankly, the FOIA office doesn't give a crap about CSEDs. They give a crap about figuring out FOIA requests. So 2 strategies there, but somehow you're going to want to find out what the IRS CSED is. And a lot of times I'll tell people, let's go with what our CSED is. Once it's passed, give it 90 days if they're not tolling or if they're not levying, and then we'll put the request in for the CSED. So a lot of times you want to keep your head down and then go after it. But if you really want to know what it is ahead of time, I would just call, get the Mod A, get the CSED dates. And then the other thing we have is I've got a CSED calculator that I used to use internally. It's now part of the executive product and the resolution package, but it's what I used to do when we had to calculate and reverse engineer the IRS CSEDs. So we use that tool to reverse engineer how the IRS calculated the CSED. And then we look at our calculations, and oftentimes we find where the IRS made a mistake. They added an extra 15 days to the rejected installment agreement, or they miscalculated something here or there. You can generally figure out why the IRS numbers are different from ours. And that's what I do. So get as much information as you can from the IRS, pretty much the Mod A. You may want to check PACER. And then from there, you just kind of compare it to our numbers. And again, if it's close within 2 years, time permitting, I'll review for you. We can come up with the best strategy to approach it at the end. Sometimes you do want to contact them and get the CSED before the CSED date. Other times you might want to wait until after it's done. So, but I'm here to offer you my going on 7-8 years experience just with CSEDs if you want to take advantage of that. So kind of the best answer I can give you there.
All right, so one more question. Do you want to put your email address back up there for anybody?
Yeah, and actually, I don't think I had my email address. I'll tell you what, let me do this. Let me hit escape.
Okay, oh yeah, there you go.
And let me do this. I will pull up Notepad and I will get it where everybody can see it. That seems to be the best. All right.
I don't think I've ever seen anybody use Notepad before.
What's programmers do? Because we can write code in here and stuff like that.
Makes sense.
All right.
Makes sense.
And our phone number is, let me make sure I get this right. Laura, you can Skype me if I'm sending the wrong phone number out. All right, so let me blow this up. Edit. Format font. Okay, 72. There you go.
Sweet.
You can email us at info@auditdetective.com or reach us. And please don't call us today in the next 5 or 10 minutes. I mean, if you got a product question or something, absolutely. I've got 2 people answering the phones this afternoon. We'd be happy to answer questions, but we were real busy before we got started. Also, let me say this. IRS eServices has been kind of intermittent this week. It seems like it'll freeze a lot when requesting civil penalties, but the IRS is due to go down from, the 17th of this week through the 21st or 22nd. They've kind of thrown the 21st and 22nd out as when eServices will come back up. They're actually launching a new irs.gov. They're not supposed to be changing eServices, but eServices is going to go down as part of this. So software won't work. You're going to get a lot of errors over the weekend between the 17th and the 22nd. So maybe not make any transcript requests until then. Once it's back up, we'll do our best to send an email out. I'm actually flying Monday morning. So if the program needs a little bit of modifying because they changed something on the website, we should be running within the first 48 hours, if not the first couple hours. I don't expect a big delay on this. It's not the big change with the text messaging of the confirmation of the login. So this is strictly the IRS pushing out a new irs.gov. It's going to look pretty cool for everybody, but eServices is going to have a couple issues between now and then. So any other questions there, Mitch?
No, I think that's probably good for now. Just a reminder though, we're going to send out your certificate as long as you were in here for 50 minutes and answered the polling questions the best you could. We'll probably send those out either tomorrow or Thursday. And then the other thing was some of you guys were having trouble with the 3 per slide page, and I have the other version where it's just 1 per page. So probably whenever we send out the certificates, we'll just send out the slides again. That'll be a little bit bigger so you guys can keep them for your records. But other than that, I think thank you, Roger, for your time today, and thank you guys all for coming. So Roger's going to, the presentation, the CPE is all done and over with. But if you want to stay and check out Roger's demonstration of tax help software, then feel free to do that. And how long do you think you're going to go for, Roger? Just give
Let's say 10, 15 minutes, and then if anybody needs anything, Laura and I'll get in. But yeah, what I'll do is just real quick here. And Mitch, are you going to stay on and maybe answer some questions for him?
Yeah, I'll be on here. I'll monitor the questions. If you guys want to send me some questions about the tax help software, I'll read them off to him.